Guys, we've got another email. We were chatting at the start of the show, you know, about the whole AXA Asia Pacific NAB thing, wealth management, potential for takeover targets. I thought this one was interesting because this is about Challenger Financial. This email is coming from Peter from Brisbane. Wants your comments on this company, stock code CGF. I've held shares in this company since mid-2008, he writes, and I'm interested to know whether you all think that they're worth holding for longer and what you think of the chart. So let's take a look at the chart to begin with, and we'll see just how Challenger Financial is tracking. As you can see, it's been certainly on an uptrend in the second half of the year, and it's around $4 now.
I look at these things a little bit differently to Francesco. I don't speculate about what consolidation there might be or who's going to take over whom and when that's going to happen. I just ask myself the question, well, you know, am I going to be a customer of this business? Do I think most people will be a customer of this business? What's their unique selling proposition? Why do I think more people will go to this business than another business? Because if people prefer a particular company, then that company has the ability to charge higher prices and make more profit. I don't think Challenger has that particular advantage, and I think it's just another financial services business. I don't think it's particularly a leader, and Francesco's already made that point. I think that's right. If you start looking at stocks by looking at their share prices, then you sort of sit there frustrated that, hey, oh, I could have bought that, you know, and it's gone from $2.50 to $4. And, you know, well, that's true in the last 6 months, 8 months, 9 months. You could have done that with a lot of stocks. But this isn't a business that I think justifies its current price.
The thing with M&A activity, though, I'm not disagreeing with Roger at all here, but the thing with M&A activity is that the acquirer will look at the business in slightly different light, because they want to see what they can. They have a view of how they can change that business to make it a better business and how it can grow for them.
They're looking at future potential.
They're looking at future potential.
What do you reckon the track record's been like on that in Australia?
Well, in the financial services industry, it hasn't been too good, and you know, there are a lot of these mid-tier companies out there with an eclectic mix of brand names, which to me I think mean nothing. Exactly right, and they stick with them. And then the other thing you got to look at is what platforms do they have. You know, NAB buying AXA, you know, there's a number of platforms there. NAB's already got a number of platforms. Are they going to consolidate that? If they do, there's a big IT spend in merging these businesses together and gaining those synergies. So for NAB, because it's such a large beast, it can look at that view for a 5-10 year period. But someone like AMP was probably looking at AXA maybe from a point of view of a 3 to 5 year period to get the synergies out of it.
But CEOs are largely baby boomers. You know, they dominate the boards of Australian companies. As children, they were all listening to Hans Christian Andersen fairy tales and the frog kissing princess, right? So the princess comes along, kisses the toad, and the toad turns into a handsome prince. Now all these CEOs reckon that their kisses are going to turn these acquired companies into princes or princesses, and there's a backyard full of toads. You know, so the track record in Australia for acquisitions has been pretty poor, in my view. Australian company, nothing gets the blood hotter than a takeover. You know, nothing gets people excited, and bankers and lawyers and accountants, everyone gets really fired up when there's a takeover, when they can smell an acquisition. You know, and the ship that you're the steward of gets bigger, and, you know, you get paid more. You know, it's all terrific. You know, it's all great. And then, of course, 2 years later, there's a write-down because you paid too much for it. And there's no shortage of companies that I can point to where that's happened in Australia.
Foster's is a beauty.
Foster's and Southcorp, a classic example. You know, and I would argue the ASX and the SFE, you know, their return on equity dropped from 30, 40, 50% to mid-teens now. They paid too much for it. So there's lots of this in Australia, and people do get excited about it. It fills up the papers. It gives us something to talk about on TV. You know, but the reality is that it hurts shareholders long term when CEOs pay too much.
Yeah. Food for thought from both of you, certainly, on that one, because it is a big one that we're discussing, and you're right, you know, this is in the headlines at the moment.
Well, I think you'll find it'll be a big theme, not just in the wealth management sector, but across the board next year, for a couple of reasons. One is we've been through what we've been through last year, and markets have crashed. The big companies have firmed up their balance sheets. They've got a war chest there. Now they're on the hunt. They're sniffing around, looking at other businesses to grow through acquisition, because they still think that these things are cheap, even though they've recovered. And to us, in the markets, we think the market's recovered. Well, things are starting to look expensive, but But to a CEO, like you mentioned, they say, well, you know, we'll pay overs for it because we think we can extract more out of it.
We got a better kiss.
Yes.
Yeah. But look, you know, forget about, I'm a terrible kisser, right? So given that I'm a bad kisser, I'll tell you what I'd pay for AXA.
Yep.
I'd pay $3.16 for AXA.
Oh, right.
And no more. So I will now, not buy NAB.
Well, it's twice that.
Yeah, correct.
Yeah, $6.37.
Yeah. And my valuation for South Corp was about $1 when Foster's paid $4.30 or whatever it was, $4.30. I had a valuation of $1 on it.
Lifting it
Yeah,
until they got just a ridiculously high
Yeah, and
price.
the analysts come out and say, oh, they can afford to pay more, and you should hold out for a better price, and then they don't want to back down. It's just been a disaster in Australia.
Well, our next caller waiting patiently, Phil from Cogra. Hi, Phil.
Yeah, how are you? Just quickly, Roger, I know one of your favourite stocks is JB Hi-Fi. I noticed it's taken a hit in the last 3 days pretty heavily, and I'm just wondering if it's just correcting itself, or do you think the strength in the American dollars might affect its earnings slightly now? And I'm just wondering what your thoughts are and where you think the stock might finish up next 2 or 3 months.
Oh, gee. Let me get my crystal ball out for you. I don't know.
Didn't yours break last year? Mine did.
Did yours break last year? His crystal ball broke. Look, have a look at the share price over. I know nothing about the chart, right? But just looking at the share price, and I know it's up on the screen at the moment, it hasn't gone up in a straight line. There's been bumps, and it's wiggled up and it's wiggled down, and this is just a wiggle down. I don't think the value of the company is going to change dramatically from the valuations that I've had. I will add one caveat though, and this is true of all discretionary retailers at the moment. If inflation picks up, if money velocity picks up and inflation subsequently picks up, well, that is going to be a problem for discretionary retailers. That will be a real problem. Having said that though, and I'm not speculating about those things, this is an A-grade business. It is sort of number one in terms of economic performance. Its value is rising significantly over the next 2 years. I do not know what the share price is going to do. My hope as a net buyer is that the share price halves. Now, I know that hurts everybody out there, and people listening to me saying that think, oh gosh, that guy's a real lunatic, but the reality is I'm a net buyer. I want to buy more. I've got cash coming in from dividends and from other sources, and I want to invest that money in great businesses when they're cheap. So if JB Hi-Fi were to halve, well, that's a good thing. I'm going to buy some more. You should buy shares like you buy groceries, and you buy more of them when they're cheaper. So I can't explain every wiggle on the screen. I'm really sorry about that. Was it Phil?
Yes.
Is it Phil? Yeah, sorry about that, Phil. I can't explain to you why the share price has gone down in the last few days. All I can tell you is I think the value's going up.
I'm going to have to move on. I'm sorry. Okay. Tony from Berwick. Thanks for waiting, Tony.
That's okay.
Berwick.
Berwick, yes.
Oh,
I think it's Berwick.
Where's Berwick?
It's in Victoria.
Oh, okay, that's bad. Sorry, Victorians. Apologise there.
I love the show.
No.
I actually run a self-managed super fund and have been accumulating BHP for quite some time. I know that the show always they're very fond of BHP. But I think I might swing across to, I've been looking at buying some Fortescue metals, and I just wondered what Roger's value of Fortescue was over the next little while.
Oh, it's a tough one to value because, it hasn't got to full production. We don't know. It's growing so aggressively in terms of its output that it's very, very difficult to actually value. My guess, and it's just a guess, is that the price is factoring in some very optimistic numbers for the future. And my question to Tony, my question to Tony is, if you've bought something that's your best thing, why would you buy something that is the second best thing unless you're certain that it's not the second best thing and in fact it's the best thing? And if it is the best thing, then the thing that you got isn't, and so you need to switch. I don't understand that logic.
Have you got those BHP valuation numbers in front of you?
Oh, okay,
all right,
I'm really sorry.
That's okay, because I was really interested to know. But okay, we're going to move on. We've got David from Melbourne. Tony from Berwick, thank you very much. David from Melbourne, hi.
Yeah, hi. I was just wondering what the panel's opinion is of a company called MacMahon's.
Okay. MacMahon Holdings, which is the stock code MAH, and we'll get the chart up on the screen. Take a look. There you go, sitting at about 55-60 cents there.
I actually did this valuation today, and for the life of me, I can't remember what it came out at.
More or less.
If David, if you go to my website, shoot me a message. I'll put a valuation up for you.
On the show, Roger Montgomery from rogermontgomery.com. Francesco de Strada from Ordmanet. Thank you both so much for your time. Merry Christmas to you both as well.
Merry Christmas.
And we look forward to chatting to you again in very nice, in 2010. To you, the viewers, thanks so much for your company on tonight's Shares edition of Your Money Your Call. Really hope you've enjoyed the program with Francesco and Roger.